Hello friends, many of my online family members have asked me and they have been concerned, I don't blame them, Vijay, are there going to be higher taxes on derivatives, which is futures and options trading? And if not taxes, are there going to be other restrictions that will curb the kind of trading that we are doing in this day and age? So this video, I will try and answer these queries of yours. I will try and address these issues, but you need to take things in perspective here. Do understand that India's market today is a fairly young market. Why do I say that? Because at least 2 out of 5 traders that are present in the market, and I'm talking about traders, not investors. At least 2 out of 5 traders, if not more, have come in after the COVID-based lockdowns were imposed. So there is no prior experience, number one. Number two, they don't have perspective that being in the market and a part of market history brings with it. Thirdly, they don't know who to turn to because their friends themselves are as fresh as they are in the market. So do understand a little bit of history here will tell you that this is not the first time there have been curbs on derivative trading in the history of our financial markets. Let's not go very far back. Let's just stick to the time when we had options and futures, which is after the turn of this century. And after Y2K came in, the markets collapsed, and we all know how people lost a lot of, myself included. I went to the brink of bankruptcy. From being a multi-millionaire trader, I went all the way down. I've shared that detail in many posts of mine. I had a tough time coming up. And SEBI, in its efforts to kind of stabilize the market, experimented with ban on short sales. It was tried in 1997 during the Southeast Asian currency crisis by many countries, including Malaysia, where Dr. Mahathir Mohamad tried to impose a ban on short sales, which failed very badly. So, amongst the restrictions that many of my online family members are asking is, hey Vijay, will there be a ban on short sales? I will address those as well. Now, in 2015, let me jump forward from the 1997 currency crisis, 9/11, after which short sales were banned again. SEBI, of course, during 2002 and 2003, SEBI and NSE became signatories to global regulatory and exchange bodies, which basically are against the idea of excessive interference in the market by way of restriction. So short sale bans are fairly unlikely. Irrespective of the fact that South Korea has experimented with it, irrespective of the fact that the Chinese are doing it in a quasi way, if not directly, I don't think it's happening in India. Allow me some time, I'll come to that. But let's go forward to 2015. In July of 2015, a new regulation was brought in that raised the ticket size of futures and options from the then prevalent 2 lakh rupees in market capitalization to 5 lakh rupees. Now, is this not a barrier by way of entry hurdle? Yes, it is. Because 2 lakh rupees to 5 lakh rupees, your span margins, your exposure margins, your mark to market, everything would go up 2.5 times. Now, this hurdle was definitely a kind of a quasi restriction on F&o traders. In 2017, again, tweaks were made. Now, there was a differential STT or securities transaction tax imposed on options to the extent of 0.017% as compared to 0.01% on futures. Why were options being taxed higher in terms of STT? Because retail were rushing into options. So this was another way the government was trying to keep the retail out of options. Remember your first tenet of taxation. You know, when I talk to people about Section 80C or any investments that are EEE, exempt under the Income Tax Act, I keep telling people taxes and laws are methods and means by which the government can persuade you to do something by reducing taxes on it, or discourage you to do something by increasing tax on it. So increasing the STT on options in 2017 was their way of discouraging retail traders to go there. Can that happen again? Possibly, yes. We'll consider the four scenarios ahead. Then you had another regulation which tweaked the concentration margin or exposure margins. Right now, when you want to trade in the Indian stock markets in the derivative segment, you pay an initial margin which is called the span margin. Now, the span margin need not be the only margin that you have to pay. Now, many of you have heard and read about what I write about the market-wide position limits. In many WhatsApp groups where I'm a part of, I notice how people make fun of this indicator as a standalone indicator, MWPL, all the more power to them. But this is one of the most important metrics a real-world trader will look at. If you're just a passive spectator, armchair analyst, you would want to basically discount it. But on the MWPL depends a lot of things. And one of the things that determines the margins is the MWPL. Prior to the tweak in concentration margin regulations, only after the market-wide position limits crossed 80% of the permitted limits did the concentration or exposure margin start rising telescopically. But after 2017, concentration or exposure margin started kicking in when MWPL reached 60% or higher, which meant the more a popular future or an option was, more traders were rushing in to trade that particular instrument, the more margin the exchange was levying, so that you found entry barriers so that the small retail investor could not get in there because his capability of taking a loss was limited. Now remember, regulations are a means of discouragement and encouragement. That is why they are made. All right. And there were many further changes if you know your financial markets history. If you're really a real world trader who considers trading as a business, you would have considered all these capital outflows and expenses to your trading journey before you calculate the pot of gold at the end of the rainbow, which you call a profit. Then there were changes to the margining system again. Previously, you could give 100% of the span margin by way of collateral. What is collateral? You could have an approved list of shares, mutual fund, bonds. You could even have ETFs, which you could give as collateral to the broker, and you need not pay margin. Of course, mark-to-market payouts, if any, had to be given by cash, but margining went out of the way. So a lot of people used to do that. Without investing money, they would trade in the F&o, and that put the exchange mechanism at risk. Here, the law was changed and 50% of your span margin can be met now by way of collateral and 50% by way of cash. Here again, mark-to-market losses have to be paid strictly by cash only. And then came peak margins. What happens when there's sudden volatility? You know, the kind of volatility that we saw on 4th of June 2024 when election results were announced. The exchange can say, hey, we are imposing an ad hoc. Ad hoc would mean immediate but temporary margin. And this would be the peak margin, and you are given 30 minutes to pay that margin, failing which there would be a kind of penalty. And it's a fairly steep penalty, far above bank FD rate of interest. So what can the government do? I've just told you the kind of tweaks that have happened in the past. Either the same tweaks can be made more stringent or there could be others. Let's discuss those now. The fact remains that in spite of all these tweaks, in spite of raising the ticket size, the contract lot size from 2 lakhs to 5 lakhs, which is closer to 8 and 10 lakhs in many cases now, the markets are still surviving and thriving. So panic mongering should be avoided at all costs. This market has been robustly faring well, and it is my belief that it will continue to fare well. Now, for the four possible scenarios. The first possible scenario, which I think is the most desirable from my point of view as a retail trader just like you, taxes are hiked, but only for institutional traders like FIIs, high frequency traders, algo based institutional traders, and artificial intelligence based high frequency trading desks. That would mean you and me would be spared the hammer of either higher taxes or higher STT or higher margining systems. Remember what all the government can do as steps to discourage trading. Now, this of course would be the most desirable. Only institutions are taxed. You and me can continue life as usual. It's all fun and games all over again. Will that happen? Budget will tell. Second option, taxes only on futures but not on options. Now, why is that? I have many a times in my past videos and my Telegram channel where I share all my research, my thoughts, my trading blueprint, the broader big picture blueprint. Here you have my contact coordinates on your screen right now. So on my Telegram channel, I used some terms which many of my online family have requested I clarify. I say I will take exposure and linear instruments and non-linear instruments. So you wanted a clarification? Here it goes. Now futures are linear instruments. Why? Now every time the future goes up by a rupee and the market lot is 10,000, you will gain 10,000 rupees, and every time the future goes down by a rupee, you will lose 10,000 rupees. So both your profit and loss are equal. Options, on the other hand, are non-linear. Why? Because if you are to buy an option and you are to pay a premium of 2 rupees when the market lot is 10,000 again, if at all you go wrong, all you will lose is that 2 rupees multiplied by 10,000, which is 20,000 rupees. So your loss is pretty much predetermined. But your gain, hypothetically, now remember, this is a hypothetical situation. This is textbook knowledge. I do not subscribe to this textbook knowledge. If you've seen my video, which you can see the thumbnail up there, I have told you that textbook and real world trading tend to be divergent. Options are non-linear. SEBI can say, look, we feel the biggest threat to a retail guy is from linear futures, and therefore we will put up higher STT for futures, we will put up higher taxes for futures, and we will raise the margins for futures. It could be either one or more of these measures, which means options buyers would be spared the hammer. Will option selling be taxed? Yes, because option selling is also linear. Why? Because when you're selling an option, you have to pay span margin, concentration margin, peak margin, and your gain is limited to the premium that you're earning. But your loss, hypothetically speaking, again hypothetically, could be unlimited. So they could tax futures buying and selling and options selling, naked options selling. But options buying may be spared. This is scenario number 2. This would not be as good as scenario number 1, but alright, it could still be tolerable. Scenario number 3, there would be limitations on the exposure allowed per individual trader. Now, I caution you before you go further. What I am sharing with you is only conjecture. What is the meaning of conjecture? Guesswork. Based on what? Based on rumors, heard on the street, buzzword, grapevine. Far from the truth, it could be just a rumor, but hey, sometimes there can be no smoke without a fire. So let's consider just the worst case scenario. So the rumor is on the street that there could be a limit on number of exposure in terms of lots that a trader can take based on many number of criteria. It could be the last IT return that you have filed and your net worth can be grabbed by the income tax, by the exchange and SEBI from the central processing cell at Bangalore where all IT returns are processed. It could not just be the net worth, but it could also be the amount of tax that you have paid based on the profits that you've disclosed in your last financial year's returns. It could also be your CIBIL report, your credit bureau and an information report about what kind of credit rating you enjoy. It could be based on the bank balance that you have on a cutoff date that SEBI could prescribe. Like I said, this is conjecture. We are just guessing. I don't know whether any of these criteria will come. I don't know whether this measure itself will come or not. But this is one of the possibilities. Now, this could seriously dampen a lot of traders' sentiments, but I do see a certain amount of merit, because if a guy is capable of trading one lot and he borrows money from his neighbors, his brother-in-law and his father-in-law, and suddenly starts doing 1,000 lots when he's actually fit for one lot, the outsized risk that he's taking jeopardizes his entire family, which is not good. So there ought to be some limitation. So yes, this could be brought in. Number 4, the most unlikely scenario, but also the worst possible scenario. Taxes are hiked across the board for all kinds of traders. SEBI says, look, I don't care whether you're retail, I don't care whether you're FII, I don't care whether you're a domestic institution. You trade options, you trade futures, buy or sell. Here is it. You got to pay me. Either by way of STT, either by way of income tax on profits, or maybe even both, and by way of margins, and by way of increased limitation on exposure sizes that you can undertake at one go. This, like I said, is the worst case scenario, in which case volumes will drop very sharply. Now, who is spreading this rumor that taxes will be spread across the board and there will be a total blanket curb on trading? This is being spread by misinformed people. And these very people are quoting the fact that SEBI has edged the retail out of foreign exchange trading. They are saying, look, if SEBI can throw out the retail from foreign exchange trading altogether, why can't they basically tax everyone and say, okay, from XYZ date, no more rampant trading in options and futures? These guys, these misinformed guys, are forgetting one thing. A, the government is a stakeholder in what you're doing in F&o. Number 1, if you make money, they make profit. Number 2, like SEBI said, 88 to 89% of the people lose money, but SEBI still collects, or the government rather still collects STT. Do you think the government will lose all that STT? And the guys who are saying, look, they banned Forex trading, are forgetting the fact, because they don't know, because they don't trade. The biggest amount of noise is made in this market by people who don't trade. Look at what happens in a cricket match. The batsman is ultra quiet. He's very, very quiet. He's focused on the ball. He's looking at what the bowler is doing. He has absolutely no interest in all the screaming and chanting that the crowd is doing, because he is a player. And what's the guy sitting in the stadium doing? He's bursting popcorn bags. He's blowing his whistles and toot horns and screaming and shouting, because he has nothing to lose. He's not playing. So it is a fact that non-players in the market create the most amount of noise. And these guys don't understand that there was never any STT in Forex. It was easier for SEBI to ban Forex trading because they had nothing to lose by way of STT collections. It is therefore the least likely scenario that there would be uniform taxes across all traders, across all players. Margins could be raised, STT could be raised, compulsions could be brought in, and restrictions on exposure size, all could be brought in at one shot. I don't think that's happening. All right. Now, only the budget and the Honorable Finance Minister will tell us what really happens. But no problem should be discussed without discussing a solution. If there is a problem, why not talk about a solution? That's what we are here for. Now, what will happen when any of these restrictions are brought in? Number 1, like I said, restrictions are more likely to come in the linear segment. So, futures buying, selling, options naked selling. All right, which means option buying may be relatively. I agree. I'm conjecturing here. I have no proof of what the finance minister is going to do. I can't read her mind. All right. So, in my humble opinion, option buyers will be left relatively untouched, and that is where an opportunity for you and me comes into the picture. Remember this video, I conclusively proved to you that it is an option seller who has a better chance of taking home the profit, which is the loss he picks up from the pocket of the option buyer and puts it into his own pocket as an option seller. Now, because option buying will be relatively untouched, people will rush towards option buying. And the very forces of capitalistic demand supply oriented markets tell you is when there's a bigger demand for something, the price tends to go up. The premium will go up in options. Also, remember what I told you about the snapcode window. Because there is a constant demand from the retail guy, and the retail guy is unorganized, he's scattered, he will put in a lot of trades at various limit prices on your snapcode window, which you are seeing on the inset box on your screen right now. The bid and offer spreads in the option will widen. That means you could get an ingress. Ingress would mean an entry, but you may find egress, which is exit, slightly expensive because the spreads would widen. You may not really notice it, the spread widening by a few ticks. A tick is a 5 paisa difference. So if the tick went up by say 20 paisa, but if the market lot is 10,000 shares, 20 paisa, hey, that's 2,000 bucks per contract. That's money for jam. For me, 2,000 rupees a contract in spreads, I would be in hog heaven if I was to get money for jam just like that. So spreads will widen, which means option writers will make even more money. So I stand by my video that option sellers will continue to enjoy a distinctive advantage over option buyers, the retail guys, and the advantage might just increase even further due to bid and offer spreads widening. Sure, if margins are going to go up, we as option sellers will have to pay increased amount of capital. But do remember, since 2015, if you're trading as long as I have, and I've been trading since 1986, we've seen all kinds of stuff go under the bridge. We've gone from zero margins when brokers used to charge no margin at all, only when shares came in that we paid. Now we've gone to upfront margin, then we've gone from lot sizes going up from 2 lakhs to 5 lakhs. Now we've gone from concentration margins, peak margins. So it's something that veteran traders are used to. Money is like a raw material. To a baker who's making bread, wheat flour or maida is his raw material. That's his raw material, work in progress, stock. Call it what you want. It's a raw material. We'll just have to put in a little more raw material to maintain the same kind of monthly absolute inflows coming in. But the return on investment is more likely to go up, gross, because options premium will go up. What happens on a net profit basis? Now this gets very interesting. If the government increases the STT and the tax slab on derivatives trading, only then do I run a serious risk of either my take home return on investment, percentage return. I'm not talking about absolute. Remember, difference, percentage. Professional traders would understand immediately. My percentage return on investment will go down only if STT and income tax is raised at one shot. If not, I'm all right. If you want to put restrictions, raise margins, limit exposures, etc., all fine. Will it require a more amount of capital? We are ready for that. A professional trader is ready to put in more raw material, which is capital. But you need to maintain the ROI. Will the Honorable Finance Minister hit the ROI of derivatives traders? We will know only after the budget is announced. Let's wait out there, and do connect with me on social media where I put up all my thoughts. If you like this video, Please help me to reach out fellow like-minded traders who want to take knowledge-based investment and trading decisions, who are smart like you, by sharing my video with your friends and social media groups, etc. If you haven't subscribed to my YouTube channel, please do so. Click on the bell icon to receive instant alerts of fresh videos being put up out here. I'm always willing to listen to your requests for fresh videos on whatever ideas, whatever subjects that you want me to touch upon. I would be happy to oblige if I can. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable day ahead. Take care. Bye-bye.